Hey everyone, welcome back to Corporate Decoder. Today we're diving into Mercury General Corporation, ticker symbol MCY, and their latest quarterly report. Think of this report as the company's homework assignment, and let's just say, judging by the numbers, they might be held back a grade this quarter. You'll see what I mean, it's quite a ride. Before we get started, if you are interested in decoding complex topics made simple, remember to subscribe and join our Discord channel in the video description for more stock insights and discussions. We're looking at Mercury General's financial health as of March 31st of this year. This report basically tells us how they did in the first 3 months of 2025, and spoiler alert, it was not great. There were over 55 million shares of Mercury General stock floating around on May 1st. That's a lot of little pieces of the Mercury General pie. This is also what they call a 10Q filling. In other words, this is a quarterly report that needs to be filled to the government. We get to learn about the company as well. Alright, let's get into the financial statements themselves. We're going to focus on the big picture here, not every single little number. First, let's take a look at their balance sheet. At the end of March, they had about $9 billion in total assets. That's everything they own. However, by the end of the last year, December, that number was closer to $8.3 billion. This implies that there is about $700 million in additional assets. It shows they have been acquiring assets recently. Their total liabilities also jumped up from the end of last year at $6.3 billion to $7.2 billion. In other words, they took on a lot more debt than assets. That isn't a great ratio. This is also confirmed when we look at their retained earnings. At the end of last year, they had $1.85 billion. That number dropped to $1.72 billion. In other words, at the end of the quarter, they actually did poorly. Now let's get to their income statement, which confirms their health. This will be a quick one. Their net income is actually a net loss, negative $108 million. Compared to last year, the same quarter, where they had a positive income of $73 million. That's a huge swing. To put that into perspective, they are hundreds of millions of dollars off from where they should be. Lastly, let's get to the cash flow statement. This can also show a different picture than what they are actually reporting. However, this isn't the case with Mercury. Their cash at the end of the period increased to $1.28 billion. This might seem like a good thing, but this actually indicates that the management doesn't know where to deploy capital for the company's future. It's better to invest money rather than hold on to it in this time of inflation. Now let's look at something more specific, like insurance premiums. Direct premiums written, which is the amount of insurance policies sold, jumped a little bit to 1.45 million from 1.3 million. In theory, all this is good because the core of their business is selling insurance. However, with this income, the company is actually reporting increasing debt payments from their customers. In other words, their premium receivables also increased to 6.6 million compared to last year's same quarter of 5.8 million. More people have debt to the company and aren't paying their bills. In insurance world, unearned premiums are premiums the company collected from customers but have not earned yet. We see that the number is increasing this quarter. It means that the company have been selling more policies recently. This is a good sign. At least the sales are still coming in. We see here that earthquake losses on fixed property policies. This is key detail. This means if there is an earthquake, they don't have to pay out as much. A big risk factor for companies that rely on California. What about their reinsurance? That's insurance for insurance companies. To protect them from massive losses, there has been additional provision for expected credit losses, and they can't collect from the insurance. Their ending balance for reinsurance recoverables went up from $0 to $1.2 million. It means the company has a harder time recovering money from companies they do business with. This creates uncertainty in whether or not they have enough money to cover losers. Lastly, let's take a peek at fair value measurements. The company measures themselves compared to other liabilities and assets. This is their risk management. They have broken down their measurement by different levels. Level 1 is the best and level 3 is the worst. The higher the level, the harder it is to actually say how well the company did. However, they don't have any assets or liabilities based on level 3 measurements. That is great. Amortization is a fancy word for saying the company is writing off an asset. During this quarter, they did that a little bit. Nothing too concerning to note here. All right, let's move to their compensation section. This is where you find out how the people in charge got paid. This is more about notional interests, aka they get more if the company does well. In the company's performance-based share unit section, the company actually lost shares. This is directly a sign that executives think the company will lose value. This area covers what happens if the company expects people to default on their payments. However, there were no such events in this quarter. This section just says a lot about standards being updated, nothing concerning to note about it for now. There aren't many changes on the goodwill side. In other words, they are still able to account for all intangible assets correctly, and they don't see a reason to change the balance. This area covers more of share-based payments. In short, certain employees get payments based on how the company does. Lastly, let's look at income taxes. Everything seems pretty normal, so we can quickly move on. It just means there aren't any funny business going on. In general, segments just relate to how they do business. In this particular case, there is only one segment that's relevant, so we can move on. The last area is about market risk. There is mention of exposure to risks in interest rates, equity prices, and credit risk. This just confirms what we've been saying about the company not doing so great. Now looking at these results more broadly, Mercury General is facing some serious headwinds. The financial numbers paint a clear picture. Profits are down, debts are up, and they had some help from the weather. Also, their debt levels and cash could be signs of bad leadership. While not all is gloomy, the company does show increases in total assets. It's not being used efficiently. This means that future actions of the company aren't clear. Alright, that's our breakdown of Mercury General's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.